Hello students. So in the last lecture we discussed with the accounting entries in the books of transferor company. Now in this lecture we will be discussing with the accounting entries in the books of transferee company. Now accounting entries in the books of transferee company first of all depends on is it merger or purchase. So there are two different accounting methods possible. Okay, in the books of transferee company there are two different accounting methods which are possible. All of you must be writing it in your notebook. Accounting methods. In the books of transferor company, there is only one accounting, 14 journal entries what we have studied. But in the books of transferee company, there are two different accounting methods which can be followed. One is pooling of interest method. Okay, pooling of interest method. And second is purchase method of accounting. Okay, I repeat, there are two different methods of accounting which can be followed in the books of transferee company. Transferee company means the company which is purchasing the business of other company. Okay, purchasing company. So there are two different methods of accounting to be followed. One is pooling of interest method, the other is purchase method. Now pooling of interest method we have to follow only in case of amalgamation in the nature of merger. Pooling of interest method is followed in case of amalgamation in the nature of merger. Whereas purchase method of accounting is to be followed in case of amalgamation in the nature of purchase. Okay, amalgamation in the nature of purchase. So basically we already studied in the lecture 1 itself how to identify is it amalgamation in the nature of merger or in the nature of purchase. For merger there are three conditions to be satisfied. All the assets and liabilities must be taken over. Secondly, at book values. And third, entire purchase consideration must be settled only in the form of equity shares except the fractional amount is paid in cash. So if all these three conditions are satisfied in the question, we will go with pooling of interest method of accounting. And if even a single condition is not satisfied, it becomes amalgamation in the nature of purchase. So we will be following purchase method of accounting. So very first task, whenever accounting entries are asked in the books of transferee company, very first task in every question will be to identify is it amalgamation in the nature of merger or is it amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, we will follow pooling of interest method of accounting. If it is amalgamation in the nature of purchase, we will follow purchase method of accounting. Okay. Now, why the name is given pooling of interest method? Because merger means company A liquidates, B liquidates, form AB Limited. So basically it is pure merger. What do you have to do? All items of balance sheet of AB, all items of balance sheet of A, all items of balance sheet of B, merge it and form balance sheet of AB Limited. So if A has building of 10 lakhs, B has building of 5 lakhs, in AB Limited building 15 lakhs. You are just combining the two companies' financial position. That's why it's called pooling of interest method. Okay, but in purchase method you cannot do it. Why? Because all assets may not be taken over. Okay, then only it is purchase if that conditions are not satisfied. All liabilities may not be taken over. So you cannot simply merge the two balance sheets, because in purchase method of accounting also agreed values may be possible, they may not be taken at book values. So you cannot merge the two balance sheet with same values. Pooling of interest method means practically the two balance sheets are just merged, pooled together. Values also same which are appearing in the balance sheet. Okay, that's why the name is pooling of interest method. Anyway, we'll be going up in detail with the journal entries, but once again, first task in the questions, whenever you are asked with accounting entries in the books of transferee company, what is the first thing we have to do? Identify, is it merger or purchase? If it is merger, follow pooling of interest method of accounting. If it is purchase, follow purchase method of accounting. This identification is not required if entries are asked in the books of transferor company which is going into liquidation, because in transferors books those 14 entries remain same irrespective of whether is it merger or purchase. Okay, I repeat, in the last lecture what 14 entries you studied, those entries remain same irrespective of the fact whether is it merger or purchase. So these methods are applicable only when accounting is asked in the books of transferee company. Okay, so if transferee company's books are asked, first you will have to identify is it merger or purchase. Let's proceed with the accounting part. Okay, pooling of interest method and purchase method. How the entries will differ, understand it. Some entries will remain same, some will differ. So very first entry to be passed in the books of transferring company is for purchase of business. Okay, very first entry to be passed in books of transferring company is for purchase of business. Now, what will be the journal entry in the pooling of interest method? Business comes in, debit what comes in, so we open a temporary account in the name of business purchase. Business purchase account debit. It's a temporary account which is opened, and whatever is the purchase price of business, it is payable to whom? To the liquidator of transferor company. Okay, it is payable to the liquidator of transferor company. So amount is payable to liquidator, credit the payable to liquidator of transferor company account. Okay, business purchase account debit. Business comes in, debit what comes in, business purchase account debit. Amount is payable to the liquidator, credit the payable, so to liquidator of transferor company account. This journal entry is to be passed with the amount of purchase consideration. Okay, this entry is to be passed with the amount of purchase consideration. Now, even if it is purchase method of accounting, the entry will remain same. First entry in both the methods remain same. So you can rewrite this entry. Don't just write the word same. Write all the entries. So rewrite this and you will remember it also in this manner. So rewrite the entry again. Business purchase account debit to liquidator of transferor company account. Okay, the entry in both the books, both the methods of accounting will remain same, and again with the amount of purchase consideration. Now, second entry. You are purchasing the business of transferor company, or maybe companies, if A and B, two companies are going into liquidation, then AB is acquiring A also and B also. So for taking over assets and liabilities, for taking over assets and liabilities. Now this entry will be important in both the methods of accounting. It will slightly be different in both the methods. Very first, assets comes in, debit what comes in. So assets account debit, or you can say that transferor company's assets now become our assets. So to bring assets in our books, AB company's books, assets account we have to debit. Then liabilities also become our liabilities. So to bring liabilities in our books, we will credit liabilities account. And difference amount is this business purchase. Okay, this is assets minus liabilities is generally the amount of business purchase. So with difference amount, you'll credit business purchase. In fact, business purchase you will credit with the same amount of purchase consideration. Okay. Now here also entry remains same, but concept is different. Main entry is same. Assets account debit to liabilities account and to, so that temporary account which we had debited in the previous entry, business purchase. Now once the assets and liabilities are taken over, that account we reverse and credit and close. And with what amount? Purchase consideration. Okay. Now what is the difference? Understand it. Very first difference. All assets will be at book value. All liabilities will be at book value. Whereas here all assets will be at agreed value and all liabilities will be at agreed value. Some assets may be at book value and some at agreed value, but if agreed values are given, then in purchase method of accounting we have to take agreed values into consideration. Whereas in pooling of interest method of accounting we have to take book values into consideration. Why? Because when do we follow pooling of interest method? When it is amalgamation in the nature of merger. And what is first condition of merger? All assets and liabilities are taken over at book value. So in pooling of interest method, you'll always have book value in this journal entry. Whereas in purchase method of accounting, agreed values may be given, then they are to be taken into consideration. This is the first difference. Second, assets will include all assets, including fictitious assets. Assets will include all assets, including fictitious assets. Means in your new company's balance sheet format, it would be other non-current assets and other current assets item. Okay, fictitious assets in the new company final accounts format, they will be under which heading in the asset side? In non-current assets, they will be under the heading other non-current assets like discount on debentures, etc. Or they will be under other current assets. So here assets will be including that, but here assets will not include, it will never include fictitious assets. It will never include fictitious assets. So other non-current assets and other current assets item in this. See, pooling of interest means you are just merging the two balance sheets. So everything of balance sheet is to be taken. Even the fictitious assets are to be taken. But in purchase method of accounting, no company will purchase the expenses and losses of other company. No company will take over the accumulated losses of other company. So when it is purchase method of accounting, then other non-current assets and other current assets items, fictitious assets items are not to be included. Further, liabilities will be including reserves. Liabilities will be including reserves. So that in shareholders funds, what you have reserves and surplus, they will also be included in the liabilities. But here liabilities will not include reserves. So if the new company does not purchase the accumulated loss of other company, Same way, old company will not sell its accumulated profit to the new company. It will give it to its own shareholders only. So assets in this pooling of interest method will be including fictitious assets, but in purchase method of accounting, they will not include fictitious assets. Liabilities in pooling of interest method will include reserves, but liabilities in purchase method will not include reserves, except statutory reserve. Now, what are statutory reserves? Statutory reserves are those reserves which are compulsory to be maintained for certain number of years as per the respective law, statute. For example, if we talk about tea and plantation companies, then they maintain development rebate reserve. As per the law, that development rebate reserve is to be continued for 5 or 7 years. So even when the company goes into liquidation and a new company is formed, it is a tea and plantation company only. They have to continue to maintain that development rebate reserve for that period of 5 or 7 years. So they have to take over that development rebate reserve. So liabilities will be excluding reserves, but statutory reserves will have to be included. But not in this journal entry. A separate entry is passed for taking over statutory reserves. I repeat, separate entry is to be passed for taking statutory reserves, and that entry we will pass at the end. Means that statutory reserves journal entry we will pass after other entries. Okay, so that we will see again later on. But right now you remember that in pooling of interest method, liabilities will include reserves. In purchase method of accounting, liabilities will not include reserves. Statutory reserves are taken over, but in the second journal entry you don't have to include any reserve. Okay, in the liabilities you will not include any reserves. Even statutory reserves you will not include, because for statutory reserves will pass separate entry. Okay, third point of difference. In pooling of interest method, any difference amount remaining between purchase consideration and share capital, any difference amount remaining between purchase consideration and share capital of transferor companies will be transferred to profit and loss account. So if it is debit balance remaining, then it's a loss, it will be transferred to P&L account debit. If it's credit balance, it's a profit, it will be transferred to P&L account credit. In short, we'll be making this workings. What workings? Purchase consideration minus share capital acquired. If purchase consideration you are paying more than the share capital, then it's a loss. That loss you will debit to P&L account. If purchase consideration what you are paying is less than share capital, it's your profit. You are paying less money. You'll credit that amount to profit and loss account. Okay. If reserves are already there, we'll try to adjust with reserves, or else any loss, purchase consideration and share capital's difference. If you are paying more, any loss you will debit to P&L account, any profit you will credit to P&L account. Whereas here we will find difference between purchase consideration and net assets. Net assets means assets minus liabilities. So any difference between purchase consideration and net asset is transferred to either goodwill account if you are paying more purchase consideration, or capital reserve account if you are paying less purchase consideration. Okay, any more amount is transferred to goodwill account if you are paying more purchase consideration, or less amount is transferred to capital reserve account if you are paying less purchase consideration. It's a capital profit, so transfer to capital reserve. Now why goodwill? Why are you paying more than the net assets you are getting? Because of the reputation of that company. Why in the negotiation or bargain would you pay more purchase consideration than the net assets? Because of the other company's reputation. So that we will transfer to goodwill. And if we are paying less purchase consideration, then it is our capital profit. So we'll transfer to capital reserve. So these are the points of differences. That's why I said to you that method of accounting will be very important. If it is merger and pooling of interest method, then find purchase consideration minus share capital of transferor company's difference and transfer to P&L account. But if it is purchase method of accounting, then find purchase consideration and net assets difference. Here share capital is compared, here net assets are compared. If we are paying more debit to goodwill, if we are paying less credit to capital reserve. Once again have a look at the second entry. Entry remains same in both the methods. Asset account debit to liabilities to business purchase. But in merger, pooling of interest we take at book value. In purchase we take at agreed values. In pooling of interest, assets will include fictitious assets, liabilities will include reserves. In purchase method, assets will not include fictitious assets, liabilities will not include reserves. Statutory reserves are taken but by the means of separate journal entry. So in this entry, we don't have to include reserves. Further difference, in pooling of interest method, purchase consideration and share capital's difference is transferred to P&L account, and in purchase method of accounting, purchase consideration and net assets difference is adjusted either with goodwill if we are paying more or with capital reserve if we are paying less. Now third entry, after taking over assets and liabilities for settlement of purchase consideration, means we'll make the payment of purchase consideration for settlement of purchase consideration. Now, whom are we going to pay the purchase consideration? This liquidator. Okay, so liquidator is the receiver, debit the receiver, liquidator account debit means liquidator of transferor company account debit, and we are talking about the method of pooling of interest. Pooling of interest means merger. Merger means all assets and liabilities are taken over at book value, and last condition was entire purchase consideration is settled in the form of equity shares only. So to equity share capital account. Here what you are going to pay in purchase consideration is only equity share capital. Okay. Fractional amount if you pay in cash, then cash goes out, credit what goes out to cash and bank account. And those basic concepts what you studied in second year BCom, I am not mentioning, they will remain same. Means if you give them the shares at premium, then you'll credit security premium account. If there is discount, you'll debit share discount account, because this is consideration other than cash. Okay, you're getting business and giving the shares, so you can give a discount also and at premium also. So those things I'm not writing. Based on the practical questions, we will see. If there is premium, then you'll also credit security premium. If there is discount, then you'll also debit share discount. But in pooling of interest method, purchase method of accounting, entire purchase consideration is paid in the form of equity shares only. So entry will be liquidator is the receiver, debit the receiver, liquidator account debit. And since you give only equity shares goes out, credit what goes out to equity share capital account. Now how will this differ in purchase method of accounting? Again, liquidator is the receiver, debit the receiver, liquidator of transferor company account debit, but In case of purchase method of accounting, you can give them equity shares also, preference shares also, cash also. So when you credit this purchase consideration paid, you can have equity share capital account also with its security premium or discount, whatever is in the question. If par, then only share capital. You can have preference share capital account also. You can have cash or bank account also. So because of the nature of merger or purchase, okay, in pooling of interest method, you'll give only equity shares, so two equity share capital account. But in purchase method of accounting, you may give equity shares or preference shares or even cash. So you can have two equity share capital, two preference share capital, two cash or bank, and security premium and discount depending on question to question. Okay, so these three entries what we discussed would be there in all the questions. Okay, these three entries what we discussed would be there in all the questions. These three entries what we discussed would be there in all the questions. Means these are the compulsory entries to be passed in all the questions. You can write as a note after this. First three entries will be passed in all the questions. Now remaining entries what we are looking at 4, 5, 6, 7. These are to be passed only if specific information is to be given. That's why I said first three entries will be passed in all the questions. But remaining entries what we are looking at 4, 5, 6, 7 or 4 more entries, they will be passed only if that information is given in the example. Which fourth entry? For issue of shares to the public. For issue of shares to the public. See, a new company is formed. There was a condition even in merger or even in purchase that at least 90% of the shareholders of new company should be same as the shareholders of transferor company. So you have the scope or a margin of issuing at least 10% shareholding of the new company to the public if you want more money. So new shares may be issued to the public also. Two entries will come here because we'll collect the entire money in one go. So bank is the receiver, debit the receiver, bank account debit, and to share application and allotment account. Since we collect entire money in one go lump sum only, so the application and allotment account. And second entry, share application and allotment account debit to share capital account. Okay, we studied this in the last year in second year BCom, that if you collect the entire money in one go, then bank to share application and allotment account, and second entry share application and allotment account debit to share capital account. And this entry remains same here also. Bank account debit to share application and allotment account. Since entire amount is collected in one go, bank is the receiver, debit the receiver, bank account debit, and full 10 rupees is collected, so you straight away transfer to application and allotment account. Then to close share application and allotment account, we reverse and debit that, and we transfer that money to share capital account. So this entry remains same irrespective of the fact whether it is amalgamation in the nature of merger or purchase. Okay, and again in this entry also premium would be there. Discount is not possible because when you issue the shares for cash, you can issue only at par or premium. So if premium is there, then in second entry you'll credit to security premium account also. Now fifth entry is for liquidation expenses of, now which company is going into liquidation actually? Transferor company. Okay, liquidation expenses of transferor company, but paid by transferee company. We are looking at which entries right now? Entries in the books of transferee company. So if transferee company agrees that whatever are the liquidation expenses of transferor company, they will bear it and pay it. Because see, if transferor company goes into liquidation, maybe you take over its cash and bank balance also. If transferor company is not left out with any money only, how will they make the payment of their own expenses? In this situation, transferee company may say that we take over entire company including your cash and bank balance and we will pay your expenses. So expenses are of the transferor company, but because everything of transferor company is taken by transferee company may agree to pay that amount. If transferor company itself is paying it and having the cash, then we have seen in that 14 entries, transferor company will pass the entries in its own books. Realization account debit to cash or bank account. If transferor company is paying it, then entry will come in transferor company's books only. But if transferor company is cashless and transferee company agrees to pay that expense, then we have to pass the entry in the books of transferee company. Now here, reserves or profit and loss account debit depending on second entry, which all reserves and P&L account are left out here. We have seen will be passing this entry including reserves, transferring this difference to P&L account. So depending on that reserves or P&L account you will debit. Cash goes out, credit what goes out to cash and bank account. Okay, so debit all expenses, liquidation expenses are an expense, debit all expenses and losses, but you debit it to reserves or P&L account depending on second entry which reserves are there, and if reserves are not there, then P&L account, debit all expenses and losses, straight away debit P&L account. But in purchase method of accounting, you can see that here no reserves were taken over except statutory reserve, but statutory means you have to maintain that reserve compulsorily. You cannot use that in paying the expenses. Here the difference was transferred to goodwill account or capital reserve account, so that will be debited. If goodwill is there in the second entry, goodwill account debit. If capital reserve is there in the second entry, capital reserve account debit. To cash or bank account. Cash goes out, credit what goes out. Now why goodwill? Why are you paying the expenses of transferor company? Transferee company, why is it paying the expense of transferor company? For its goodwill, for its reputation. Because they are taking entire company including its cash and bank. So to maintain its reputation, they are paying their expenses. So see, that's why I told you write all the entries in both the books. If it is pooling of interest method or merger, then for liquidation expenses of transferor company paid by transferee company, you will debit reserves or P&L account. But if it is purchase method of accounting, then you will record goodwill or capital reserve account depending on you have goodwill or capital reserve in second entry. And in both the situation, cash goes out, credit what goes out to cash or bank account. Now other than liquidation expenses, incorporation, see new company is formed. So certificate of incorporation, prospectus, certificate of commencement, registration to be done. Such registration and establishment expenses are also involved. Incorporation means registration. So incorporation and establishment expenses. Okay. New company is being formed, so they will also have their own registration and incorporation expenses, establishment expenses. So respective expenses whichever are incurred, preliminary expenses account debit or respective expenses whichever are incurred, debit all expenses and losses, expenses account debit, cash goes out, credit what goes out to cash and bank account. And this entry remains same here also. Whichever expense is incurred, debit all expenses and losses, preliminary expense or respective expense account debit. Cash goes out, credit what goes out to cash and bank account. So normal journal entry is only to be passed for that. And the last entry, I told you 7 entries are there. So last entry, for settlement of liabilities. After taking over the liabilities, in some typical situations, you may have to settle the liabilities also. For example, in the old company there are 10% debentures. Now they create obstacle. We will not allow the companies to go into liquidation. You have to take the consent of shareholders also and creditors and liabilities also. So if they say that we will not agree, we don't agree to merge in the new company, then you may have to attract them by giving something more. You may say if you are 10% debentures in old company, in the new company we will give you 12% debentures. You will earn 2% higher rate of interest. So now allow the companies to merge. In this situation, settlement of liabilities will take place. So whichever liability is being settled, liability is the receiver, debit the receiver, liabilities account debit, and whatever you give them to cash or bank account, generally you won't be giving cash or bank, I'm writing it, but in practical questions what will happen? 10% debentures account debit to 12% debentures account. As I said, against 10%, now in the new company you are offering 12% so that they are ready to get this merger done. So cash and bank would be very rarely there. Okay, so this is just a concept we are writing right now. But in practical questions, the entry will depend on the language of the question. Okay, and in both the situations, whether it is merger or purchase, the entry will remain same. Liabilities are the receiver, debit the receiver, liabilities account debit. Cash goes out, credit what goes out to cash or bank account. But as I said, cash or bank mostly would not be there. This last entry would be debenture to debenture only. Generally, we will be having settlement of liability of debentures only. But 10% debentures to 12% debentures and so on. In detail, we will see when we solve the questions. Now, this 8th entry is possible only in purchase method of accounting. Which one? This statutory reserves. We discussed, we'll pass separate entry for that. So, for taking over statute, this entry will not come in merger. Why? Because in liabilities itself, we include reserves. All reserves are included in liabilities itself. But in the purchase method of accounting, in liabilities, we pass the entry excluding reserves. So for statutory reserves which are to be taken over, I told you separate entries to be passed. So for taking over statutory reserves, what entry we will pass? For taking over statutory reserves, a temporary account is opened called as amalgamation adjustment account debit. Why amalgamation adjustment? Because we have to do the adjustment to take over these reserves. So amalgamation adjustment account debit to statutory reserves account. Now generally statutory reserve, I gave you one example, development rebate reserve. You can have investment allowance reserve also. Okay, examples of statutory reserve, development rebate reserve, this is in case of tea and plantation companies. Investment allowance reserve, this is in case of finance companies. They have to maintain investment allowance for certain number of years. You can have export profit reserve. These all are statutory reserves. Export profit reserve if it is export oriented business. So these reserves would come in the category of statutory reserves if given in the balance sheet. And for taking over these reserves in purchase method of accounting, separate journal entry will be passed at the end because we have to make adjustment to take over these reserves. So amalgamation adjustment account debit to statutory reserve account. Once the period of that statute, 5 years, 7 years is over, then you reverse this entry. Once that statutory reserves are no more required, Then after 5 or 7 years, you'll reverse this entry. Statutory reserve account debit to amalgamation adjustment. And in balance sheet, this amalgamation adjustment will appear under the heading other non-current assets. And statutory reserve obviously under the heading reserves and surplus shareholders funds. But amalgamation adjustment will come under which heading? Other non-current assets. Okay. And once after 5-7 years, the reserve is no more required, we reverse and both the accounts will disappear from the balance sheet. Okay. So all of you revise these concepts properly. One more last thing. We discussed first 3 entries will be passed in all the questions. 4 to 7 entries are passed only if specific information is given in the question. Okay. Entries 4 to 7 will be passed only if specific information is given. Entries from 4 to 7 will be passed only if specific information is given. Means only if you are given in the question shares are issued to public, then this entry will come. Only if you are given in the question that liquidation expenses are paid by transferee company, then this entry will come. Only if establishment and registration expenses are given in the question, then this entry will come. Only if liabilities are to be settled, this entry will come, otherwise not. And this will come only if statutory reserves are there. So this 4 to 7 or 8 entries will come only if specific information is given in the question. But first 3 entries will be there in all the questions. Okay. So we wind up with today's session, today's lecture. All of you rewrite the entries in the books of transferor company as well as transferee company. Okay, rewrite 14 entries as well as this 7 and 8 entries again. Keep a practice of writing all these entries every day one time until this chapter is over. Or else when we solve the long questions, you will have trouble. Okay. Bye everyone. Take care. Love you all.